Good evening, everyone. Hope you all are doing well. So today we are going to discuss the one of the most important topic for F7 financial reporting, which is ratio analysis and interpretation. We all know in your exam in the section C, there is a question on the ratio analysis and interpretation. Even though I have promised to all the students that I will cover each and everything, there will nothing be left on the SBR and F7 playlist with concern to the lectures. In the previous lectures, we have covered the IAS and IFRS. There are few lectures left, but that are not based on the concept wise. That lectures will solely be based on past papers for your further preparation. All the concepts we have covered in the previous lectures have nothing to do with today's lecture, as ratio and interpretation is a different and a separate topic. So make sure you guys are attentive because this is one of the most important topic for your exam. It will be a deciding factor in your exam. Either you will pass or you will not make in this attempt. So be attentive before starting this lecture. This is ratio analysis and interpretation for F7 or FR students of ACCA. Ratio analysis and interpretation. Why ratio analysis and interpretation is most important? Let's start with the purpose of ratio analysis. Ratio analysis helps to assess profitability, liquidity, efficiency, and solvency of an entity. Okay, let's cover each of these aspects. Profitability means whether the organization is in a profitable phase or at a loss. Liquidity means how the cash flows of the entity is surviving. Either entity is going towards the going concern issues or there are events and conditions which may cast doubt on the entity's ability to continue as a going concern. Efficiency and solvency means company is going to bankrupt or redundancies. It allows comparison over time, trend analysis, and against competitors or industry averages benchmark. In simple words, this is about the analytical reasoning or analytical procedures. It assists stakeholders. Stakeholder means other than shareholders, those general public, those users which have direct or indirect interest towards the company, such as customers, suppliers, or other persons. It assists stakeholders in decision making and identifying strength, weakness, and improvement areas. So, this is why ratio analysis is important because it gives the overall structure, overall information about the company to the users, to the stakeholders. Now, there are few limitations. Ratios are based on historical figures. Different accounting policies reduce comparability. Yes, this is right. Ratios don't consider qualitative factors, brand value, staff skills. Inflation may distort figures. Yes, seasonal factors can mislead. So these are the limitations which you should have to be skeptical about solving your ratio and analysis versus interpretation question. Now, categories of ratios. Ratios are grouped into five main categories: profitability ratio, efficiency ratio, activity ratios, liquidity ratios, gearing solvency ratios, investor ratios. Few are important from your exam perspective, but don't worry, we will cover each and everything. Now, profitability ratios. We have gross profit margin, operating profit margin, return on sales, net profit margin, return on capital employed, ROCE, ROC, not a red rose, it's a ROCE, ROCE, okay? Return on equity, ROE or ROI, something like that. Return on assets. Okay, let's read the formula of each one. Gross profit margin, gross profit divided by revenue multiplied by 100. Remember gross profit, how to calculate the GP, sales minus cost of sales. What will be the interpretation? Measures the profit after direct cost of sales. Decline may mean higher production cost or lower selling prices. Operating profit margin, operating profit divided by revenue multiplied by 100. Show the operational efficiency before finance and tax. Gross profit minus expenses, but before financing and tax will be your operating profit margin. Net profit margin, or profit after tax divided by the sales or revenue multiplied by 100. Overall profitability after all expenses and taxes. Return on capital employed rose. Operating profit operating profit divided by capital employed. Okay, guys, few students may confuse between the reserves and capital employed, such as equity. Reserves, all these things are component of the equity. So whenever you are calculating the equity kind of components such as ROCE or ROE, you have to calculate each component. Operating profit divided by capital employed multiplied by 100. There is another formula. Capital employed equal to equity plus non-current liabilities. Interpretation, key measure for investors, higher ROS equal to more efficient use of capital. If the ROS percentage or ROS ratio is higher as compared to last year, it means the efficiency of the use of capital is valid or is accurate. Return on equity, profit after tax divided by equity, measures return for shareholder. This is for the returns of the shareholders. Return on assets, profit before interest and tax. Yes, this is more inclined towards the IFRS 18. Remember the new standard which replaces IAS 1, because now in IFRS 18, we took the figure of PBIT. Profit before interest and tax divided by total assets multiplied by 100 gives you the ROA ratio. How effectively assets are used to generate profit. So these are the interpretation which you should have to write once you get these ratios. But don't worry, I have a separate sheet in which I have listed down all the interpretation and analysis. I will share in the WhatsApp group. So don't worry. Now we have efficiency ratios or activity ratios. Ratio inventory days or inventory turnover days. Same as receivable days, payable days, and asset turnover. Okay, inventory turnover days, inventory divided by cost of sales multiplied by 365. Why 365? In a year, there are 365 days. Average days inventory is held. High equal to overstocking, low equal to stock out risk. Receivable days, trade receivable divided by credit sales multiplied by 365. Average days customers to take to pay. Longer equal to cash flow issues. Why? Why the high level of inventory, like high days of inventory period and high days of receivables are at high risk? Let me give you an example. Let's say you have 20,000 rupees and you give them to your friend. And this is 1 year had already been passed, but your friend didn't pay that 20,000 amount to you. What do you think? Will this 20,000 remain the same? No, because of inflation, as we all know, TVM, time value of money, money loses its value over time. In the last year, that 20,000 can be used more efficiently as compared to this year because of inflation, because of other monetary policies. So this is why if our customer delay in payments, it will affect the efficiency ratio. Same goes for the inventory. If we have stock which are not going to sell for the longer term, such as they are still in our inventory in our warehouses, so it means there is an overvaluation of stock, and we all know we should have to record it at lower of cost or NRV. So there is a risk of NRV loss. Now, payable days. Higher payable days are actually good. Why? Because we have that cash which we should have to payable to the creditors. But now we are not going to pay because of any conditions. Maybe there is a contract between us, like me and the creditor. But if we have high payable days, so it's good for us. Why? Because we have that cash. Okay, let's see. Trade payable divided by credit purchases. Okay, guys, here you have to divide it by credit purchases. Average days taken to pay suppliers. Longer, better, short. Term liquidity but may harm suppliers' relations. Yes. Better short-term liquidity but may harm supplier relations. Yes, this is possible, and there is a possibility that your supplier may asset turnover, revenue divided by capital employed, measures how efficiently assets generate revenue. So now we have covered two kind of ratios. Now liquidity ratios, most favorite ratio of your examiner. Current ratio, current assets divided by current liabilities. Ideal benchmark between 1.5 to 2. Too high equal to idle. Assets too low, liquidity risk. Quick asset test ratio. Current assets minus inventory divided by current liabilities. Excludes inventory as it's less liquid. Ideal benchmark 1 1 is 1 is to 1 ratio. Okay, okay, guys, I have an important question for you. Let's say you have a client and they have a perishable inventory, and the inventory is going to result in an NRV loss, but the management is not going to record the NRV loss, as they are not going to record their inventory as per IAS2, lower of cost or NRV. What do you think? What could be the possible reasons? Can anyone tell me, please? If you want to highlight this thing, you should have to comment down, because that. Okay, guys, I am repeating the question again. Let's say you have a client and the client is not going to record their inventory at lower of cost or NRV. What do you think? What will be the reason? Okay, let me tell you. What if your client is going to record it at lower of cost or NRV? Of course, there will be an NRV loss. And what if they record it at NRV? So don't you think their current assets will be lower than the last figure? Let's say previously the current assets value were 100, but now the current assets value is 90 after incorporating the NRV impact. Now your client is going to acquire a loan, and for that the current ratio, can anyone tell me what will be the current ratio in this case? Let me give you an example again. The current assets figure is 90 and the current liabilities are 100. So it's up to you. You have to calculate the difference and tell me the logical reason. I have explained all the hints. Okay. Now cash ratio. Cash and cash equivalents divided by current liability. Strictest liquidity test, rarely used alone. Okay, now we have gearing solvency ratios. Please, guys, be attentive. Ratio, gearing ratio, formula debt divided by Debt plus equity. Again repeating, debt divided by debt plus equity. Multiply by 100. Interpretation. High gearing greater than 50%. Higher financial risk. Debt to equity ratio. Debt divided by equity. Simpler debt equity measure. Interest cover. Operating profit divided by finance cost. Times interest can be paid. Less than 2x indicates risk. Now, investor ratios for shareholders. Ratio, formula, and interpretation. Earning per share. We all know we have covered this topic in the previous section. Earning per share EPS. Can anyone tell me why earning per share is important? Because it will help us in identifying the shareholding percentage, how much shareholder will get. Okay, earning per share, profit attributable to ordinary shares divided by weighted average number of ordinary shares. In simpler term, it's profit divided by number of shares. Key profitability indicator for investors. Price earning ratio, PE ratio, market price per share divided by EPS. High price earning per share equal to higher market expectations. Dividend yield and dividend cover. Dividend per share divided by market price per share, annual return from dividend as percentage of share price. Dividend cover, EPS divided by dividend per share. Number of times earning cover the dividend. Okay. So in these four ratios, the first two ratios are very important. Now, from these three ratios, all three ratios are important, but let me tell you about interest cover. Interest cover means a debt and profitability ratio used to determine how easily a company can pay interest on its outstanding debt. Okay, so it means how easily a company can pay the interest on the loan which they have acquired. Okay, so now we have, we are covered with the interest. Oh, there is one left. Total shareholder return. Capital gain plus dividend divided by opening share price multiplied by 100. Total return from holding these shares. Now, interpretation guidance. How to interpret these ratios once you calculate it. Interpretation guidance when interpreting, consider trends, benchmarks, external factors, accounting policies. Trends. You have to compare the current year with the past year. You have to comment on the trend. After that, benchmark. Compare to industry average. Because in your exam, the examiner will ask you to compare it with this and that industry. Okay. We will solve the questions, then you will have the better idea. External factors, economic conditions, inflation, interest rate, other factors. Accounting policies, different depreciation, inventory valuation, amortization, or revenue recognition methods such as point in time or over time affect comparability. Now, common exam real world pitfalls. Percentage with markup profit as percentage of cost. Using total sales when formula needs credit sales. Okay, guys, these are the important things. These have been extracted from the examiner comments. Again, repeating from start. Confusing margin percentage with markup profit as percentage of cost. Most of the students get confused between profit on markup or on margin. Margin means sales, markup means cost. Using total sales when formula needs credit sales. Okay, you have to be attentive. Using closing inventory instead of average inventory. Ignoring seasonal fluctuations in working capital. Interpreting ratios in isolation instead of looking at the overall picture means do not calculate or interpret your ratio based on the general terms. You have to consider the case specific factors. Now, full work example interpretation style. Company A summary. Let's say Company A GP margin fell from 40% to 30%. What do you think? Just do the brainstorming in your mind. Just pick the points. Why the GP margin is going to fail? First, you have to think how GP margin is calculated. It's sales minus cost of sales. So it means the cost is higher and sales price is lower. That's why GP gross profit is declining. Possible cost increase or selling price cut means decreases. Inventory days increase from 50 to 72 days. What could be the possible reason? You have inventory, it's not going to sell. That's why the inventory is still in your stock. That's why their days are increasing. Overstocking or slow sales. Receivable days increase from 30 to 45 days. Means you have give the goods and services to the customer on a credit terms and still the customer has not returned your payment. So now poor credit control. There is a high risk of bad debt that the customer may become bad debt or bankrupt. Current ratio dropped from 2 to 1.3. What could be the possible reasons? It's all in the numerator and denominator. All the answers of the ratios are in the numerator and denominator. If there is something decreasing because of numerator or because of denominator, then your interpretation will be revolved around that figure or that component. In the current ratio, we have current assets divided by current liability. Now you have to be skeptical which value is lower between them. Let's say current assets value is lower than the current liability. So your interpretation will be revolved around that. Gearing rose from 40% to 65%. What could be the possible reason? First, tell me the gearing formula. Look, this one. Debt divided by debt plus equity. Of course, it means we have acquired so many debts, so many loans. That's why debt equity ratio is higher. ROS dropped from 18 to 10% means not efficiently use of company's capital. Now, in the end, there is a conclusion. Company A faces declining profitability and increasing liquidity solvency risk. Management should investigate cost controls, review credit policy for pay receivables, and reduce reliance on debt for gearing ratio. Now, there are few important things which have been extracted from the examiner's report. Point number one or issue number one, workings are essential. Examiner feedback consistently highlights that missing or unclearly presented workings can cost students significant marks, even when answers are correct. Always show clear workings, whether in line, in tables, or separately. Not doing so can even nullify correct ratio answers due to mark scheme requirements. Scenario based interpretation. We all can calculate the ratios. Calculation of the ratio is not hard and fast rule. Even the class 6 student or the primary secondary student can calculate these ratios if he or she knows the formula. The main thing is interpretation analysis. You are not a PG student. You are a professional qualification student. So you have to be skeptical. Your analytical reasoning should be high because you are trained for the futures. You are a future leaders. As the ACCA slogan is thinks ahead. So you have to be skeptical. You have to be attentive. Scenario based interpretation in real exam scenarios, especially consolidation or group based questions. Candidates often lose marks by failing to incorporate scenario details or ignoring group specific information. Incorporate commentary on trend drivers, underlying causes, and consolidation effects. Structured logically under headings like performance, position, future concerns, and conclusion, accounting estimates are judgments used in accounting. Number three, use tentative language when interpreting. Smart tip, use words such as perhaps, likely, possibly. The examiner expects not simply just starting the change in ratios. Okay, guys. This shows maturity in interpretation and aligns with examiner expectations. Recommended additions to your notes. Best practice exam technique sidebar. Always show workings. Use scenario detail. These are the two important things, nothing else. Due to rising inventory days, perhaps sales are slowing. Structure ratio interpretation with headings. Mini example interpreting with scenario. Add a worked example that includes tentative language and groups the commentary. Performance, group profit margin fell from 40 to 32%, likely due to increased cost pressure or competitive pricing. Means there is another competitor who is going to sell the same thing on different price or at a better price. Maybe he or she is going to offer a discount. Position inventory days increased from 50 to 72 days, possibly indicating overstocking or overvaluation or sluggish sales. Future risk receivable days rising suggest potential cash flow strain if not addressed. Now, in the end, we have a conclusion. In summary, while the company remains profitable, the declining liquidity and efficiency trends suggest cautious monitoring and management actions. Highlight examiner emphasis on consolidation effects. Add a note. When interpreting group ratios, consider how consolidation, adjustment, goodwill, intra-group elimination affect comparability and overall ratio trends. This is a summary table which we have studied above. So now guys, we are done with interpretation and ratio analysis. If you guys have still any doubt or any queries about interpretation, feel free to ask. Ratio question is not that much difficult. The calculation is simple and straightforward. You just need to enter the data in the formula which we have discussed in this lecture. Once you identified the ratio, you have to comment, you have to interpret it with the prior year figures or with the industry average. Just pick the data. If there is a data of the industry, pick the data of the industry and start linking with the company's data. Why the company's ratio is going down or upward, whereas the industry ratio is stagnant or is also increasing or decreasing. This is how you have to link your answer. This is how you have to draft your interpretation. We will solve few questions so that you guys have better clarity and understanding on the ratio analysis and interpretation. Again, repeating, if you have any questions or any queries, feel free to ask. Also, I will upload the list of the interpretation of each ratio in the WhatsApp group link. If any student want to add in the WhatsApp group, please feel free to comment down. I will give you the link. Take care, goodbye, and best wishes as you are just 20 days ahead from your exam. Take care, goodbye.